The broadcast is now starting. All attendees are in listen-only mode.
Good day, everybody, and welcome to our webinar with Merchant Tech Capital. My name is Danelle, and today Merchant Tech Brandon from Merchant Tech will be taking us through their top picks for 2019. Brandon, good day.
Hi, my name is Brandon Smith, and I will be presenting on behalf of Merchant Tech Capital. Together with the research team, we cover a universe of approximately 50 mid and small cap stocks and have been doing so for Standard Bank for the past 5 years. Our research can be found on the Standard Bank online platform. In today's webinar, we will be discussing our top picks for the coming year. These are stocks which we believe have notable potential upside and which the market has been keeping at a low rating. The past couple of years have been particularly difficult for the South African economy, which was marked by threats of credit downgrades and plummeting business confidence. The increase in business confidence following the election of Ramaphosa was short-lived, as business confidence has returned to levels prior to the election. Analysts expect increased strike action leading up to the 2019 general elections, which could have a detrimental effect on macroeconomic indicators. The small and mid-cap space has demonstrated weak performance relative to the all-share index over the past 12 months. Valuations have fallen dramatically as a result of the poor market sentiment. Owing to thin analyst coverage of the small and mid-cap space, over-penalized stocks may remain below value for relatively long periods of time. However, this does offer investors with potential bargain purchases. This graph shows our stock universe and how the space has been impacted by the factors we just discussed. It has been a difficult time for investors within the space. However, large sell-offs and low tides give some of the better opportunities the chance to present themselves. In looking for these opportunities, we believe that by isolating the factors that have driven financial success previously and assessing the sustainability of these drivers, there is value to be found by investors who understand these businesses from the ground up. Our top picks from the small and mid-cap universe for 2019 are Baldwin, Westcol, Vunani, Adapt IT, and EOH. These are all relatively high-risk, high-reward picks. However, we believe that these stocks bear notable potential upside if their individual challenges are successfully managed. It is our view that the potential upside outweighs the potential challenges associated with each of these stocks. Our first pick is Baldwin. We like Baldwin because they seem to have really tapped into the niche but growing market of aspiring homeowners in the R1 million range. As the South African middle class expands, they have come up with a winning, inexpensive formula for developments and have been doing this for some 20 years. Baldwin is a leading national residential property developer of large-scale sectional title estates for South Africa's growing middle-income population. The group recently announced plans to supplement its core model with a rental model. The lifestyle estates offer a range of additional features such as restaurants, gyms, concierge services, etc. Baldwin's most recent interim results were pleasing, and the group saw revenue increase by 33.5% as a result of strong demand for units. The group handed over 1,058 units compared to 734 units in the prior interim period. In order to mitigate development risk, construction of new developments is generally undertaken against pre-sale of units. The group builds and markets residential estates on a phase-by-phase basis, with phases typically consisting of 50 to 100 units. This allows for appropriate risk management at each stage of development. The average selling price for the period decreased slightly from 1.2 million to 1.1 million. The average selling price per unit is expected to decrease due to a reconfiguration of the block design in response to market demand. Management plans on introducing new design 1-bedroom, 1-bathroom and 2-bedroom, 2-bathroom apartments at lower prices but at the same gross margin. We expect that this will result in higher sales volumes and consequently higher revenue, despite the reduction in selling price. A new element of Baldwin's business is the provision of annuity-based services to the group's developments. Baldwin Fibre, a subsidiary launched during the period, will own all fibre infrastructure across Baldwin estates in the future, with the intention of becoming a large standalone fibre operator across South Africa. Internet service providers will rent this infrastructure from Baldwin as part of their monthly fee to customers, and Baldwin expects to earn between 400 and 500 per customer per month. This is still at an early stage, but is expected to make a meaningful contribution after approximately 4 years. Currently, 1,548 homes have been installed and 721 homes have been connected. Returns are expected to increase over time. The group obtains development finance on a phase-by-phase basis, secured against pre-sales of the specific phase being financed. The financing consists of 70% loans from major banks such as Investec, Nedbank or ABSA, with the remaining 30% being funded with equity. At the end of the period, the group's debt-to-equity ratio was 15% compared to 29% in the comparative period. This is significantly below the group's threshold of 50%. Both our DCF and relative PE valuations indicate that the share is undervalued with significant potential upside. Westcoal is our second pick. We like Westcoal because of its efficient operations and the fact that it is trading at a deep discount to its intrinsic value. The group's operations extend over multiple mines, and the group's recent acquisition of Keaton Energy has allowed for synergies and cost savings to be realized. The group has a strong balance sheet and secure access to funding. The main business of the group is the mining, processing, and sale and supply of coal. Coal product is mined, sourced, and supplied to clients in local industry, including power generation, manufacturing, and petrochemical sectors. The key strategic thrust of Westcoal is to be a leading junior coal miner with a sustainable resource base and a coal trading operation. The group has unlocked synergies following the Keaton acquisition, which has resulted in economies of scale and a reduction in operating expenses. The acquisition of Keaton Energy has resulted in better than expected cost savings of 40 million rand per annum, with a further savings to be expected to be unlocked. The savings are a result of significant synergies, the closing of Keaton Energy's head office and downsizing of Keaton's senior staff. Additionally, the acquisition resulted in increased mining capacity. Locally, the demand for coal outstrips the supply. South Africa is extremely reliant on coal as a cheap and reliable energy source. During 2017 and 2018, the demand for coal outstripped the supply of coal, and this trend is expected to continue. Consequently, we expect the price of coal to remain favorable over the short to medium term. The group has the necessary funding in order to continue to finance its operations over the short to medium term. Of the 650 million rand long-term funding arrangement the group secured in the prior period, 313 million has been utilized. The group's exposure to Eskom increased, being 50% of the group's revenue, up from 42% in the prior period. However, Eskom has never made late payments or defaulted on payments to the group. Therefore, we do not believe that there is significant risk in having Eskom account for such a large portion of revenue. The group is somewhat protected against decreases in the coal price owing to the fixed terms contracts in place with Eskom. These contracts have built-in yearly price escalation. However, this does mean that the group has not benefited from the rising coal price to the same extent as some of its competitors. Although our DCF valuation and relative PE valuation indicate the share is undervalued and fundamentally the share looks good, on Monday the CEO abruptly resigned, which is a cause for concern. Our third pick is Vunani. What we find appealing about Vunani is the fast-growing asset management business and the group's strong performing and highly profitable private equity division, which has benefited from the favorable coal price. Vunani is an independent, black-owned and managed diversified financial services group with a unique positioning in the South African business environment. The latest set of results saw revenue increase by 46% to 234 million, driven by strong performance by the private equity division off the back of increased mining activity and favorable coal prices. Improving margins remains a key strategic focus of the group. Management's focus on enhancing synergies between business segments and monitoring spending on an ongoing basis has yielded positive results, with the net profit after tax margin increasing from 9.8% to 12.5%. The group saw assets under management increase from 21 billion rand at year end to 26 billion as a result of significant inflows to Vunani fund managers and Purpose Vunani. The significant increase in assets under management at Vunani Fund Managers of 22% is expected to positively impact profitability and revenue generation. The group remains committed to growing assets under management and becoming South Africa's leading boutique financial services group. Although market conditions are expected to remain challenging and management does not expect significant growth in outperformance fees, Vunani Fund Managers did benefit from higher performance fees during the period. However, the group will benefit from an increase in management fees resulting from the substantial increase in assets under management. Fairheads is making good progress in increasing assets under administration, which increased by 4.8% to 6.5 billion rand. The division added 3 new clients during the prior year: McDonald's, ADT, and Amplats. Fairhead's capability of administering assets in the non-contributory phase of retirement aligns with the government's aim of providing easy-to-understand, value-for-money products to low to mid-income consumers. The group's performance was constrained by the prevailing market conditions. Despite the limited growth in domestic financial assets, the group managed to achieve pleasing results which speak to Vunani's ability to navigate a difficult climate. The group is positioned to capitalize on improving market conditions over the medium term. Our valuations indicate a potential upside of between 27 and 45%. Our fourth pick is Adapt IT. Adapt IT's business model, which involves acquisitions of commercially proven software businesses, has allowed the group to dominate its niche and has allowed the group to maintain relatively high margins. Most of its contracts are annuity in nature. Adapt IT is an innovative, specialized IT services and solutions provider to a range of industry sectors, including manufacturing, education, financial services, and energy in 38 countries around the world. Adapt IT pursues a diversified growth strategy aimed at creating a global niche integrated software business with plans to reach annualized revenue of 3 billion rand by 2020. Adapt IT's strong growth levels are from a combination of healthy organic growth as well as acquisitive growth. Despite subdued market conditions, we believe that Adapt IT's fundamental business model remains intact. Owning the IP of their software gives the group a strong position and protects the business against dominant players in the market. The annuity nature of the group's revenue makes it defensive and sustainable in terms of long-term contracts and protected margins. Adapt IT will continue to acquire earnings-enhancing software businesses, realize synergies between its specialized software businesses, and focus on diversifying into other African countries. Management has stated that over the next few years, further investment will take place to diversify the energy division away from the oil and gas market. The group's weakness is around relying on acquisitions in order to achieve the desired levels of growth. However, the group does experience comfortable levels of organic growth. The group's most recent results saw relatively flat growth owing to difficult market conditions. However, the long-term fundamentals remain strong. Margins have held up and annuity revenue remains relatively strong. Although organic growth may lack over the short term, growth will be fueled by acquisitions. Adapt IT's results demonstrate resilience in a difficult economic environment and show strong prospects for future growth. Our last top pick is EOH. EOH has been a market leader for decades, and despite the crash of its share price in 2017, we believe that under the leadership of new management, the group has the potential to experience a significant market re-rating. Management has committed to strengthening the balance sheet and optimizing each of the individual businesses in a bottom-up approach. EOH and its subsidiaries offer a range of solutions in industry consulting, technology services, software, IT infrastructure, industrial technologies, and business process outsourcing. EOH was a market darling before the collapse of its share price in 2017. The share price suffered as a result of allegations of corruption. However, these are currently unfounded. Significant delays in cash collection from the public sector and reduced government spending in the ICT space is adding to the group's plight. Despite this, EOH boasts excellent employee, customer, and contract retention and continues to dominate the South African ICT market. Although this is a high-risk pick, we believe that there will be significant recovery over the long term and that the collapse of the share price offers an opportunity for investors. The group's new CEO, Stephen van Coller, has altered acquisitions and committed to addressing the group's debt and strengthening the balance sheet. The group is now focused on streamlining operations and attaining the most appropriate capital structure for each of the individual businesses. To facilitate growth, remain relevant, and to continue to promote Black economic empowerment, the group signed a long-term partnership with Labashe, a 100% Black-owned investment holding company, providing an opportunity for both parties to jointly pursue and benefit from growth opportunities. The Labashe deal will result in total equity investment of 1 billion rand over 12 months, of which half has already been injected. Following the results announcement by Adapt IT, EOH share price dropped by around 15%, as it is likely that the market expects similar results from EOH. However, we remain confident in the long-term value of the share, and based on the group's long-term strategy, we are comfortable overlooking the impact the prevailing market conditions have on the share price. This concludes our presentation, which I'd like to thank you for joining in on. If you would like more in-depth information on any of these companies or any other companies in our coverage, you can find our reports on the Standard Bank online platform. Please refer to our disclaimer. Thank you.